When a conflict starts anywhere in the world, most people immediately look at news headlines, political updates, or stock market charts, trying to understand what will happen next. But experienced market participants often look at something much simpler first: oil prices. This is because oil is one of the fastest indicators of how serious a global disruption might become, even before the real economic effects are visible in daily life. To understand why oil is so important, we first need to understand what oil actually represents in the modern economy. Oil is not just fuel for cars or airplanes. It is the foundation of transportation, manufacturing, agriculture, and global trade. Almost every physical product you see around you depends on energy at some point in its production or delivery. This means when oil prices move, they are not just changing fuel costs, they are indirectly affecting almost every part of the economy. Now, during a global conflict, the key question markets try to answer is very simple: will energy flow be disrupted or not? Even if the answer is uncertain, that uncertainty alone is enough to change prices. Oil markets are extremely sensitive because oil is shipped globally through long supply chains, and many of these routes pass through narrow and strategically important areas. One small disruption risk can affect the entire system. This is where behavior becomes more important than physical reality. In theory, oil supply might not be interrupted at all. Ships may still move, refineries may still operate, and production may continue normally. But markets do not wait for confirmation. They react to probability. If traders believe there is even a small chance of disruption, they adjust prices immediately to protect themselves from future risk. This is why oil often moves first during global conflicts, even before other markets react. To simplify this, imagine a long line of water pipes supplying an entire city. If someone announces that a key section of the pipe might be damaged, people do not wait for the water to actually stop flowing. They begin storing water, suppliers raise prices slightly to manage uncertainty, and the system adjusts instantly. Oil markets behave in the same way, except the scale is global and the reactions happen within seconds instead of days. This early reaction in oil prices is what makes it such an important signal. It is not just a commodity price, it is a reflection of global stress levels in the physical economy. When oil rises quickly during geopolitical tension, it often signals that the market is pricing in higher uncertainty about transportation, supply chains, or regional stability. There is also a psychological reason why oil is watched so closely. Human beings tend to focus on visible, simple indicators when facing complex global events. Oil prices are widely reported, easy to understand, and directly linked to everyday life through fuel costs. This makes them a natural attention anchor during uncertainty. Even large financial institutions rely on oil as a quick reference point for global risk. But behind this simple observation is a deeper system. Oil prices are influenced by expectations, not just supply. When conflict increases, traders begin estimating possible scenarios. Even if actual supply has not changed, the fear of future disruption creates what is called a risk premium. This is an extra cost added to the price of oil to compensate for uncertainty. This risk premium is not fixed. It changes constantly based on news, perception, and market positioning. If tensions increase, the risk premium rises. If tensions calm down, it falls. This means oil prices can move up or down even without any real change in physical supply. The movement reflects collective expectations about the future rather than current reality. Another important factor is how quickly financial systems respond. Modern oil markets are deeply connected to electronic trading systems, hedge funds, and global banks. These systems react within seconds to new information. When geopolitical news breaks, algorithms and traders immediately adjust positions. This creates fast price movements that often happen before any real-world consequences are visible. Insurance costs also play a major role. When conflict risk increases in certain regions, shipping insurance becomes more expensive. Oil tankers that pass through sensitive areas must pay higher premiums. These additional costs are then passed along the supply chain and eventually reflected in oil prices. This means even without physical disruption, the cost of transporting oil increases simply because the perceived risk is higher. When we combine all these elements, we can see why oil becomes a leading indicator. It reacts to expectations, psychology, risk pricing, and logistical costs all at the same time. This makes it one of the first markets to respond when global uncertainty rises. Smart investors pay attention to this because oil often acts as an early warning signal for broader economic changes. If oil rises sharply and stays elevated, it can signal that inflation pressures may increase in the future. This is because energy costs feed directly into transportation, production, and goods pricing. On the other hand, if oil stabilizes quickly after a shock, it can signal that the market believes the disruption will remain limited. However, it is important to understand that watching oil is not about predicting exact outcomes. It is about understanding how the system is reacting to uncertainty in real time. Oil does not tell the future with certainty. Instead, it shows how the global economy is currently interpreting risk. There is also a structural reason why oil is so sensitive compared to other commodities. Oil is globally traded, highly standardized, and used everywhere. It cannot be easily substituted in the short term. While countries can adjust energy sources over time, in the short run, demand for oil is relatively inelastic. This means that even small changes in perceived supply risk can create large price movements. To understand this better, think of oil as the bloodstream of the global economy. If there is even a small concern that blood flow might be restricted somewhere, the entire body reacts quickly. The reaction is not because the flow has stopped, but because the system is designed to protect itself from potential danger. Over time, this behavior creates a repeating pattern in financial markets during conflicts. First, news of tension appears. Then, oil prices react quickly based on fear and expectations. After that, other markets begin adjusting as the economic implications become clearer. Stocks, currencies, and bonds often respond after oil has already moved. This is why oil is often seen as a leading signal in global macroeconomics. But there is another important layer to this. Oil does not just reflect conflict risk, it also influences it indirectly through economic pressure. When oil prices rise, transportation and production costs increase. This can lead to higher inflation in many countries. When inflation rises, governments and central banks may respond with policy changes, which then affect financial markets more broadly. This creates a chain reaction that starts with energy and spreads through the entire economic system. From a broader perspective, this shows how interconnected modern economies are. A single commodity like oil can influence global inflation, trade flows, and even political decisions. This is not because oil itself is powerful in isolation, but because so many systems depend on it simultaneously. In the end, smart investors focus on oil during global conflicts not because it is perfect or predictive, but because it reacts early to changes in expectations. It is a mirror of global uncertainty. It reflects how markets feel about risk before those risks fully appear in the physical world. Understanding this helps build a clearer view of how modern financial systems operate. Prices are not just reactions to what has happened, but also to what people believe might happen. Oil sits at the center of this process because it connects physical supply chains with psychological expectations in real time. This is why it remains one of the most closely watched indicators during periods of global tension.